Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Macroeconomic data, Micron earnings, and big tech AI capex. This video presents a direct informational narration of the source document.
Here's our agenda for today's explainer. We'll start with macroeconomic data updates, then look at bank stress tests, tech sector capex pressures, Micron earnings and guidance, tech stock updates and AI monetization, and finally wrap up with near-term market risks.
All right, let's dive into Section 1, Macroeconomic Data Updates.
Let's break down the latest economic indicators, starting with inflation. The May personal consumption expenditures, or PCE, rose 0.4% month over month. Now, that is slightly below the 0.5% expectation, but it's certainly a bump up from the prior flat reading. Looking at it year over year, May PCE hit 4.1%, which actually exceeded both the 4.0% forecast and the previous 3.8%. Moving to core PCE, the month-over-month rate came in at a positive 0.3%. That's right in line with expectations, though a bit warmer than the previous 0.2%. Core PCE year-over-year also met expectations at 3.4%. On the employment front, initial jobless claims dropped down to 215,000. That's below the expected 225,000, signaling that the job market is staying pretty stable. However, continuing claims did tick up slightly to 1.821 million, sitting just above the 1.80 million estimate.
Here's a really striking figure for you to consider. First quarter GDP was revised upward to a median of 2.1%. And according to the source document, a massive 74% of that Q1 growth was attributed directly to artificial intelligence investment. Think about that. AI is driving a vast majority of our current economic growth.
Moving right along to Section 2, Bank Stress Tests.
Let's check in on the structural health of the banking sector. The Federal Reserve recently ran their evaluations, and large U.S. banks successfully passed these stress tests. Because of this clean bill of health, these institutions are now initiating collective shareholder returns. What does that mean exactly? Well, it specifically involves significant dividend hikes and preparations for increased stock buybacks, which is a strong reflection of overall sector stability.
Next up, Section 3, Tech Sector Capex Pressures. Right now, we're seeing a fascinating dynamic dividing the technology industry. It's essentially big tech versus the semiconductor suppliers. Big tech companies, the ones building these massive data centers, are facing immense capital expenditure burdens to fund all this infrastructure. Recently, this heavy spending has correlated with declining stock performance and rising component costs. On the flip side, you have the semiconductor suppliers. As the parts sellers, they're experiencing surging revenues and huge market optimism precisely because they're the ones supplying the hardware necessary for these massive data center buildouts.
To put this into perspective, let's look at some specific companies. Apple saw its stock drop 6.1% after they announced product price increases which were driven directly by spikes in memory costs. Similarly, Microsoft fell 3% after warning consumers to expect higher Xbox prices due to these escalating component costs. Broadly speaking, the tech sector has faced its worst month since April 2022. Adding to the broader market sentiment, reports indicate that OpenAI is currently leaning toward delaying its initial public offering until next year. That move strongly signals caution from their underwriting advisors regarding the current market timing.
That brings us to Section 4, Micron earnings and guidance.
Let's review Micron's highly anticipated third quarter report, and the numbers are undeniably impressive. Q3 revenue came in at $41.46 billion, which handily beat the $35.69 billion expectation. Adjusted earnings per share hit $25.11, outpacing the 2049 estimate, and their adjusted gross margin reached a staggering 84.9%. Not only did that beat the 81.9% expectation, but it's a massive jump from just a 39% margin year over year.
Looking forward, their guidance is just as strong. For the fourth quarter, expected revenue is projected between $49 and $51 billion, sitting comfortably above the $43.24 billion estimate. Q4 expected adjusted EPS is targeted between $30 and $32, again beating the 25.3 estimate. And they project an expected adjusted margin of 86%, surpassing the 83.6% consensus. Now, here's a detail you absolutely don't want to miss. Micron noted that it has completed 16 supply chain agreements across various sectors. And get this, 14 of those agreements guarantee a cumulative minimum revenue of approximately $100 billion. These contracts include strict price floors and volume commitments. So essentially, they act as a massive revenue safeguard, almost like a put option, guaranteeing minimum cash flows for the duration of the contracts.
Let's map out the market's consensus timeline for Micron based on the source data. Currently, in 2024, the industry is in a heavy capital expenditure phase, and that spending is expected to scale up to an estimated $950 billion next year. Fast forward a bit past the end of the upcoming fiscal year in August 2026, and we arrive at August 2027. This is projected as the consensus peak for Micron's EPS, estimated at approximately $12. This peak is calculated based on the current and anticipated CapEx growth of their major clients. But what happens after that? Well, by August 2028, the market actually predicts a period of flat growth, or even a slight decline from that 2027 peak.
Moving on to Section 5, Tech Stock Updates and AI Monetization.
Let's quickly review the current structural support levels for the major tech players. Apple has returned to a strong support zone, sitting between 265 and 281. Google has stabilized near its support of 311 to 325, and it's maintaining a reasonable forward valuation. Amazon is nearing its forward valuation floor around 219, and they notably just announced an additional $13 billion cloud and AI investment over in India. Meanwhile, Microsoft recently broke below its 360 support level and is now transitioning into a consolidation phase. Meta is trading within a pretty dense support zone between 482 and 540. And finally, Nvidia. While its extremely high market cap certainly limits its agility, its valuation metric still remains within a reasonable framework.
So, what does this all mean for the big picture? The overarching narrative for all these tech giants rests entirely on one thing: AI monetization. If this monetization is successful, these companies will transition their massive capital expenditures into actual revenue, directly driving US GDP and ensuring market stability. However, if this cycle turns out to be an unmonetizable bubble, the failure to generate returns on these historic investments could trigger a global financial crisis. And the source explicitly notes that a crisis of this nature would be significantly worse than the 2000 dot-com crash. Why? Because of the currently unprecedented levels of global debt and credit currently tied up in these ventures.
Finally, we reach Section 6, Near-Term Market Risks.
The source identifies three specific, currently untriggered near-term risks that could shake up the market. First, we have pension month-end portfolio rebalancing, which could lead to systematic equity sell-offs. Second, commodity trading advisor, or CTA, algorithmic triggers are poised to execute, specifically noted around the 7312 level. And third, there are extreme hidden leverage exposures baked into the market structure. These highly leveraged positions are lurking just beneath the surface, and they will only be exposed and forcefully unwound if the market experiences consecutive gap-down trading sessions.
We'll leave you with this final structural question to consider based on all the data we've covered today. Will big tech's unprecedented capital expenditures successfully monetize and continue driving GDP forward? Or is the broader market highly vulnerable to those extreme, hidden leverage risks waiting just beneath the surface?